Central Bank of Nigeria, CBN, lifts cash deposit restriction on domiciliary accounts, pegs daily withdrawal by $10,000. South African billionaire now richest person in Africa after Dangote's wealth drops by $2.80 billion. Plus, oil falls on China growth, uncertainties as gold prices also extend losses. The program is Business Express, reaching you from Abuja, Nigeria's capital. I am Musa Abubakar, your guide. Well, it's good to have you join us. Now let's bring you up to speed with business development. The Central Bank of Nigeria has lifted cash deposit restrictions placed on domiciliary accounts, granting account holders the liberty to withdraw up to $10,000 per day. The Apex Bank stated this in a press statement it issued on Sunday, providing further guidance to deposit money banks on the operational changes to the foreign exchange market, announced on June 14, 2023. This follows an extraordinary Bankers Committee meeting held to discuss the implementation and implications of the policy changes for the banking public. According to the CBN, the policy changes aim to promote transparency, liquidity, and price discovery in the foreign exchange market in order to improve foreign exchange supply, discourage speculation, enhance customer confidence, and ensure overall stability in the foreign exchange market. According to the Director of Corporate Communications, Dr. Isa Abdulmumin, the CBN, in line with deliberations at the meeting, provided further guidance to deposit money banks. He said all visible and invisible transactions are eligible for the investors and exporters window. The CBN emphasized that all deposit money banks will ensure expeditious processing of all eligible invisible transactions on behalf of their customers using the applicable rate at the I&E window, adding that ordinary domiciliary account holders will have unfettered and unrestricted access to funds in their accounts. Inflation is a critical economic indicator that impacts various aspects of daily lives, from the prices of goods and services to the purchasing power of individuals and the overall health of the economy. Today on Business Express, our focus is on May 2023 inflation figure recently released by the National Bureau of Statistics, where inflation ticked up to 22.4% from April's 22.2%, moving further above the upper bound of the central bank's 6.09% target range. Joining us to shed light on this issue is a renowned economist who has been closely monitoring the country's economic trends. He is Uche Owalike, a professor of capital market, Nasarawa State University, Kefi. You're welcome, Prof.
Thank you, Musa.
Well, looking at the latest inflation figures, what does this reveal about the current state of Nigeria's economy?
Well, it shows that we are still far away from macroeconomic stability. If you consider the fact that inflation has been trending upwards, since even January 2021. And if you take that side by side with the recent GDP number that was released by the National Bureau of Statistics for the first quarter of 2023, which puts the GDP figure at 2.31, it tells you that macroeconomic stability is still, very far. And you rightly noted there that this is way, way high when you compare that with the central bank's target. Central bank's target is a maximum of 9%, between 6 and 9%.
6 and 9%.
We're having as high as 22.41 as of May. Yes, globally inflation rate, has been on the rise, but in some economies too, is beginning to moderate. But we're not seeing that here, despite the central bank's efforts since May 2022, when the central bank started tightening monetary policy. You recall that the MPR, which is the anchor rate, is today 18.5%. Largely because of this rise in inflation, and unfortunately it has not been able to tame the inflation. Okay, and part of the challenge we have had in our own case is because much of this inflation is caused by factors that are non-monetary, factors over which the central bank maybe has little or no control. Okay. Look at the situation today. You have inflation rate at 22.41. But the food inflation component, food inflation is 24.8, around 25%. All right. Urban inflation is 23%. You expect that to be higher than rural inflation, which is up around 21%, which you can explain, as a result of maybe the high transport cost. Okay. Another way you can see transport cost coming into the inflation number is if you now consider that food inflation is highest in Ondo State, which is put at 30.5%, and least in Sokoto, around 18.9%. So you can see the margin between Sokoto and Ondo, 18.9% and then 30.5%. That tells you that if we had a good transport system, cheaper transport system, the margin, the disparity, the differential, wouldn't be that wide, because what it means is that it would be easy to move from where it is cheap to where it is very expensive. So the point I'm making is that cost of transport, fits into inflation quite significantly, and that's why I'm afraid that even with this first subsidy removal, it's going to get worse.
Yeah, the president mentioned about the cost of borrowing, that they need to actually, check the cost of borrowing. And with the persistent increase in inflation, and we've seen over some time now, the microeconomic policies has been targeted towards tightening the monetary instrument. So how do you think this would actually play out? Because
it's going to be difficult. The president was talking about, of course, which is desirable.
Increasing
he was talking
cost
about
of
reducing interest rates in the economy.
Interest rates.
Yeah, so that you can have a low interest rate environment, and for
so how do you
achieve
this with the inflation?
Oh yes, that's the challenge now. You see, again, let me say this: in monetary policy, there is the policy trilemma. Trilemma means in terms of the three prices. Remember, the central bank has a mandate to maintain price stability.
Yes.
And what is price? Price in terms of the three prices: exchange rate, interest rate, and inflation. Okay, so the trilemma that the central bank has is the difficulty in having low inflation rate, low interest, and low inflation. It's not possible, because when you have high rate of inflation, the response to it, especially when it is demand pull, when it is caused by too much, when the money supply is high and you want to curtail it, is to respond using your traditional tools. One of which is to raise the monetary policy rate, increase the cash reserve requirements, which, as we are talking today, is already high, at 32.5. Increase your liquidity ratio, which is 30%. So when you use this instrument, traditional instruments, and of course, the OMO is also there, all right, to fight inflation. And what it means is that the banks themselves, because what is monetary policy rate? It is the rate at which the central bank lends money to the banks. So when the central bank lends to them at 18.5 plus 1, that's the corridor, okay, that's 19.5. In turn, but they will also lend at a higher rate because they will end up adding the other costs, okay, before lending. So the higher the MPR, the higher the interest rates in the economy, because MPR is the anchor, all right? So it's difficult to have high inflation and low rates in an economy such as ours, okay? So that is where the challenge will be. And of course, once interest rates are high, businesses have difficulty accessing credit, okay? And that can also hurt even job opportunities, job creation, because it will affect their bottom lines, and some of them may end up laying off workers because they can't produce. All right, so these are the challenges we are having in the economy right now. Inflation is really a challenge, and that's why, in my view, I think the reforms that are coming now, much as they are welcome, it's important that the government should also have an eye on the impact, the adverse impact these reforms are going to have on the economy. As I said, the reforms are well intended, no doubt, and they of course have their benefits. But of course, this kind of thing, you have advantages and disadvantages. There has to be a deliberate measure to address the adverse consequences of some of these
what measures are we actually
now talking about? For example, when you are collapsing multiple exchange rates, and of course you are collapsing them at the higher equilibrium price, you are also taking off fuel subsidy in one fell swoop. And I just read that with effect from July, okay, electricity tariffs. Yes, they're going up. Yes, I read that they'll go by 40% or so. Because according to them, the multi-year tariff order, the tariff they agreed was based on exchange rate of 441 naira, and then inflation rate of 16.9. And since exchange rate has gone up now, inflation rate is also going up. Automatically, the tariffs will go up.
Wow!
So when you have increase in electricity tariff, you have fuel price, then you also have exchange rate. All of them combined, at the same time, the results will be galloping inflation.
But like the
because
interest,
what you have now, you can say creeping inflation is moving from 22.2 to 22. So it may be creeping. But the moment all of this begin to weigh on the economy, you can have galloping inflation. And
okay. Now, what does this the floating of the naira? How does it look? How would you analyze the impact now on the latest figures of inflation?
We may not see the impact until this month. Remember, the announcement was made only a few days ago. So we can't see the impact from May. The inflation figure we have now is that of May. But we are likely to see that happening for June, okay? Because when June and July, of course, there will be the lag effect in the sense that what has already been imported must have been imported. A few of them may have been imported at those that succeeded at the market. Substantial must have been done at the parallel market, no doubt. But there are also some that may have also enjoyed the secondary market intervention window, maybe through that. And remember too, before now, the fuel, the import of fuel also enjoyed some subsidy, forex subsidy. So now that they are all gone, okay, what you should expect is that the general price level will rise. Okay, I'm saying it will impact inflation, but the argument is that Nigerians should brace up for difficult times in the interim, that it's only going to be in the interim, that with time, once we begin to see inflows of forex, already foreign portfolio investors are expected to come in. That's why you find in the stock market, positioning is taking place, and the stock share prices are rising, especially the banking stocks. You can see they're rising because the banking sector is the major vehicle for bringing in capital into the country. So foreign portfolio investments investments will come in. So that may, of course, improve supply, but it may not really solve the supply problem. The supply problem, in my view, can only be checked or tackled or effectively addressed when we have multiple streams of forex, when we're able to diversify an export base, not through FPI, because FPI is temporary. FPI is hot money, okay? They come and invest in your government securities, invest in your shares. Once anything happens, they go away. And when they're going away, they're also depleting reserves because they're going with forex. So what we need in this country is foreign direct investments, which is longer term and which may not really come now, because there are also other factors that influence foreign direct investments, including security, including your business, climate. Okay, so the point I'm making is reforms are welcome, but it's also important for government to be thinking of stopgap measures to cushion the impact of this, the impact it's going to have on the economy. Part of this stopgap measures will be the compensation measures they've been talking about. I don't think, yes, minimum wage is part of it. I also think that the government should be thinking of non-cash palliatives as contained in the policy advisory, non-cash palliatives in order to cushion the effect, all right? In education, whether it's in education, whether it's in health, the National Health Insurance Scheme, for example, less than 5% of the population is enjoying it. Okay, that can be expanded. Okay. Transportation. Yes, and transport. Mass transit, having many buses, on the road. Yeah. I also think, with respect to this fuel subsidy thing, if there is time, it's just for me to recommend that if it is possible in the interim to have commercial, vehicles and vehicles owned by educational institutions to be able to buy fuel at subsidized prices from NNPC filling stations in the interim, okay, before things normalize. Because as it is now, with the way it is in some states, schools are not they've been asked to attend school only 3 times in a week. In some other states, they tell them come to work only 3 times in a week. If we do that again, of course, continue to do that, productivity will be affected. And of course, it also has long-term consequences. When you say, for example...
So it seems like there's no actually quick fix to this.
Yes, of course. But as I said, the palliatives, whatever palliatives they have, they should expedite action on them. Yes.
Okay. Thank you very much, Professor Uche Owadike. Thank you for sharing your thought with us.
Thank you, Musa. Thank you for inviting me.
Now, moving on, oil prices fell on Monday as questions over China's economy outweigh OPEC Plus output cuts and the 7th straight drop in the number of oil and gas rigs operated in the United States. Brent crude fell 17 cents to $76.44 a barrel, while U.S. West Texas Intermediate crude lost 31 cents to $71.47. Both contracts ended last week with gains of more than 2%. And now to the commodities market. Gold and silver futures declined slightly in early Monday trading after falling last week due to a hawkish tone from the U.S. Federal Reserve. Let's now see how other commodities are trading on the global market. And now for a review of activities on the floor of the Nigerian equities market for the week ended June 16th. Here's Moplanda Kok.
Equity equities market in Nigeria closed on a positive note last week after opening for 4 trading days, as Monday, 12 June 2023 was public holiday to commemorate the Democracy Day. The NGX All-Share Index appreciated by 5.49% to close the week at 59,000 basis points. Market capitalization increased to 32.126 trillion naira as investors continue to ponder over the latest inflation data from the National Bureau of Statistics. 4.2 billion shares worth 62.1 billion naira in 44,344 deals were traded by investors on the floor of the exchange. The financial services industry, measured by volume, led the activity chart in the week, with 3.303 billion shares valued at 45.2 billion naira traded in 23,490 deals. The oil and gas industry followed with 247.3 million shares worth 2.3 billion naira in 3,561 deals. The third place was the consumer goods industry. All other indices finished higher in the week, with the exception of NGX Industrial Goods and NGX Growth Indices, which depreciated, while the NGX SM Index closed flat. A summary of price changes shows that 77 equities appreciated in price in the week. 24 equities depreciated in price, while 55 equities remained unchanged.
And now the bulls struggle to lay hold on the equities markets in Nigeria this Monday as investors envisage a positive week. The NGX All-Share Index appreciated to 59,016.12 basis point. Market capitalization advanced to 32.124 trillion naira. Investors exchanged 892.954 million shares valued at 11.147 billion naira in 9,274 deals. Jai's Bank, Sterling Bank and Universal Insurance were the toast of investors as they topped the market chart in terms of volume of traded shares. And now to global market. European stocks drop as market jitters remain. Let's join Bosede Abel for more on global market update.
European market fell at the start of this new trading week as investors remained jittering over the economic outlook. DAX dipped 0.52%, FTSE 0.33%, and CAC 40 also dropped 0.44%. Asia markets were also largely lower, although Japan's markets were still hovering near 33-year highs. Investors also looking ahead to China's loan prime rate decision on Tuesday after the world's second largest economy cut some of its key lending rates last week. Stocks in the U.S. slipped on Friday as Wall Street closed out a huge week in which investors received a pulse on rate hikes from the Federal Reserve, plus encouraging inflation data. On Monday, the S&P 500 ticked down 0.01% to close at 4,454.25. The Dow Jones Industrial Average slipped 16 points or 0.05%, and the Nasdaq Composite also lost 0.03%. The same negative trend is seen in most African stocks, with the South Africa JSE Africa Top 40, Tunisia and Namibia's overall index on the negative lane, while Ghana's GSE Composite rose marginally. Bosede Abel, Business Express.
And now this is where we end this edition of Business Express. We value your feedback, so keep the comments, observations and suggestions coming. Be informed that all previous episodes are available on YouTube on the NTA's channel. Join us again for the program on Tuesday at 9:30 a.m. I'm Musa Abubakar. Have a nice day.